Are we no longer happy when interest rates go down? Have they lost their ability to cheer financial markets? This is the question we wrestle with as we open up this week. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And as we get into the final month of this very tumultuous year for financial markets, yet another pivot in the way things work seems to be underway. So what we'll do here is we'll take a look at what exactly is going on and why it is that the markets are suddenly behaving very differently than they have for most of the year, and why that seems to be, as ever, linked to what's happening with Fed policy expectations. And the question now, perhaps, stopping to be more about what interest rates are doing and shifting into why they're doing it. Because indeed, if you ask the first question versus the latter, you end up at very different conclusions and very different implications of those conclusions for financial markets from a risk on, risk off, stocks higher, lower, dollar higher, lower kind of perspective. So let's first consider what last week looked like by way of stage setting. And the immediate first thing that jumps out is that there was a dramatically sharp move down in U.S. interest rates last week. And of course, as we've talked about extensively here on Macro Money and elsewhere, when interest rates go down in the U.S., they go down everywhere. And that's because the U.S. dollar is the quintessential unit of global commerce. So when it becomes cheaper to borrow dollars, it becomes cheaper to borrow. Full stop. Period. Everywhere. With maybe the possible exception of a place like North Korea, which is disconnected from the global financial system. Otherwise, when the cost of borrowing dollars comes down, the cost of borrowing for any economic activity virtually anywhere in the world becomes cheaper. And in that context, these moves make for a very interesting cross-market exercise, because what we find is a dramatic decline in the 10-year yield, a dramatic decline in the 2-year yield. And yet, a very modest 0.7% gain for the S&P 500, a catch-all for U.S. stocks. The high-flying NASDAQ essentially unchanged, and that's easily the more interest rate sensitive of those two indices. It's, of course, packed with tech names, which tend to be very sensitive to the cost of borrowing. Crude oil down, and actually down more than the prior week, so seemingly no great support for it as you get this this shift in rates toward a more cyclical easing of monetary conditions, and something that ought to be on balance better for a commodity that depends on global growth for momentum, because of course there is more demand if growth is better, and if interest rates are lower, growth has an easier time appearing. The dollar, completely counterintuitive here, actually higher as yields decline. We can see here, looking at the euro as a benchmark, it was down 0.6% against the greenback last week. Now, to be sure, there was a little bit mixed in here with the eurozone weakness, but even taking the outsized weakness of the euro by itself out of the picture, the dollar was still up. It was up against virtually every one of its major counterparts, with very few exceptions. And so you get this strange setting for the markets where on a week when yields were down, stocks didn't really capitalize. The dollar was flat to slightly lower, maybe a little bit higher in certain very specific spots. but generally soggy and certainly not taking a major step down in line with what the yield picture would suggest. Crude oil not really cheering. Gold was really the only one that had any kind of meaningful textbook-like response, a 3.3% rise for gold. But of course, at the start of this week, gold seemingly rode those coattails to hit a new record high, only to collapse, with the price of gold here actually on the day at the start of this week looking dramatically lower. So we get this sense here that we have some degree of exhaustion in the narrative that really was the driving influence for markets in November. November was very much about higher rates coming off, about rate hikes getting factored out of the outlook, and stocks and bonds rallying in tandem. Bonds because interest rates were falling, stocks because the cost of financing earnings was declining. Just to put a bit of context on this gold move here, at the open of this week, it had rallied an additional 3.6% just at the open. It then finished the day down 2%. So a really dramatic swing in gold, seemingly, again, clashing with even what was a somewhat textbook version of the story last week. And so when we consider what might be going on here, the question naturally is, well, since we spent November applauding lower rates across financial markets, is now perhaps the time to start thinking about why those rates are going down, which is, of course, the now almost certain onset of a global recession. And if that is indeed what is occurring, then the way these markets are going to be responding to central banks, to interest rates, to economic data, might very well make for a very dark and ominous December to close out this year. Now, this week, hopefully, we're going to get a good bit of economic news to test where we are here and whether we still care about if rates are lower or why they're lower. And we begin in Australia. Here, there's a central bank monetary policy announcement on deck, and we are going to see what it is that the markets do in response. Now, the expectation, as you can see here, has become dramatically more dovish. So in the big dots there, we have where the policy path was when the RBA last met on November the 7th. We can see there we were still expecting perhaps another rate hike. So here's where we got to there, 4.35 on the target rate. And the expectation was that we were going to go here perhaps in the direction of 4.5 and over, which would, of course, comport with one more interest rate hike, perhaps over the course of 6 months. We can see here this lands us at about 4.6, which if we were to add a 25 basis point rate hike to 4.35 would land us precisely here. Now look at what's happened since. Not even just relative to here, but even just relative to last week. The policy path has become much more dovish. And so now, looking out from 4.35 out 6 months, really no change. A little bit of an upward nudge here, but not enough to make for a 25 basis point rate hike. So there's a little bit of a chance, and I do stress a little bit of a chance of further tightening, but it is seen as minuscule at this point. And from there follows a rate cutting cycle that, as of the end of next year, looks like it'll give us at least one 25 basis point reduction. That would be somewhere in here. So a year from now would be the beginning of December, and it looks like we have a drift here of about 10 basis points. So by the end of the year or early 2025, it looks like one cut is in the mix. And of course, this makes sense. If we look at the way that Australia's economy has been performing, the past 2 months have been woeful. If we look at the leading purchasing managers index numbers here, the composite, which tracks the economy taken together, services and manufacturing, we can see here is the lowest we've seen it since the COVID bottom in 2021. You'd have to go all the way back here. So about the early kind of second half of 2021, just after mid-year, to get growth as weak here, to get contraction as fast as what we're seeing at this point. And as ever, this is done in the logic of PMIs. So under 50 is contraction, above 50 is expansion, and the further you go, in this case under 50, the faster the contraction. So what we're looking at is increasingly deteriorating economic conditions in Australia. That seemingly is something that could give the RBA reason to shift its rhetoric in a more dovish direction with today's announcement. Certainly no rate change in the outlook, as we can see here. No cuts yet on the menu, but perhaps those cuts come up sooner. Perhaps we get a dovish adjustment in the tone, whereby this curve is going to flatten down some more, and perhaps even as soon as here, so that we start to see cuts maybe not a year out, but perhaps closer to 6 months out. And maybe we don't get one maybe, but closer to 2. And then the question will be, do the markets still like that? Are the markets looking at that and saying, oh, good, another central bank has decided to make money cheaper? That would be what the optimism in November was built around. Let's applaud. Stocks higher, dollar lower. But if the market is now caring less about the cheaper money and more about central bank after central bank is retreating from rate hikes because a recession is immediately on the horizon, well, then perhaps it's the other way that we are heading. And evidence that yet another central bank is getting ready to throw in the towel on the inflation fight, perhaps that is going to tell us, well, this situation really is dire and really is global. And central bank after central bank is getting cold feet. That does not bode well for earnings. It does not bode well for consumption or employment. All of which may be a very negative story from that perspective. Were equities to care about the prospect for business building, let's say, and were currencies to care more about the business cycle aspect rather than sentiment cheering because more support is coming. It's a very similar story when we get into the next policy announcement for the week, this one from the Bank of Canada. Here, too, over the course of November, a dramatic dovish shift in policy. If we take a look here, the last time this central bank met on October the 25th is the big dotted curve there. The little dots are a week ago. The very steeply pointed solid line is currently. Here, there is no question of how long the holdout is going to be. We're already looking a year out at rates that are a full percentage point lower. So if we're at 5 now and we're essentially at 4, 3.98 a year from now, then a full percentage point in cuts has occurred over the course of 2024. So clearly, again, a story of weakness and something that the central bank is likely to have to acknowledge because, as with Australia, this is rooted in economic malaise. If we take a look here, what's going on with Australia as of October, aggressive contraction in the composite index. And again, the weakest we have seen it since going all the way back to the beginning of last year. And we've actually already had the manufacturing numbers updated for November. That little pop that we see in this index here showing slightly slower contraction in manufacturing in October, it has since come back down and is now contracting faster in November. A similar story might well follow for the services and the overall composite index when those numbers come out in just a few days. So we're looking at a situation again where there's clearly a downturn in growth. There is clearly the expectation of a more accommodative central bank response led by the Fed and bleeding into these other central banks to follow, because, of course, again, it is the Fed that is the pace setter for global borrowing costs. And the question becomes, again, if this central bank follows suit and becomes more dovish, do the markets care about that making money cheaper, or do they care about the recession that this is in response to? And finally, we have what is going to be a busy week of U.S. economic data. We'll start with the culmination, the sort of crescendo first, and that'll be Friday's U.S. jobs report. Here, we're looking for a modest pickup in the pace of job creation, up from 150K in October to give us a rise of 186K this go around. The jobless rate seen holding steady at 3.9%. Not a controversial set of numbers here, and not anything that might move the needle on Fed policy expectations one way or another. Should note that U.S. economic data has been increasingly underperforming relative to forecasts. That's according to data from Citigroup. And so we may get still weaker numbers. So we may get a higher unemployment rate. We may get a shallower rise in payrolls. Leading into this report, we will get the job openings piece of data here that is going to give us a sense for how much appetite there still is and what the vacancies picture looks like. We're looking for a climb down here, and not a dramatic one, but nevertheless, the trend toward cooling labor demand from the beginning of last year, where it peaked at about 12 million, that seems to be continuing. And again, U.S. economic data has been underperforming increasingly over recent weeks. So there's some risk that this misses forecasts also. And then finally, we get some lead in from the ISM services survey, and very critically, the employment component of this survey, which is a very critical consideration for the Fed. We don't have forecasts for that part of it, but we can see that the overall index is seen nudging up a hair from 51.8 to 52.2, and that the prices component is expected to continue to drift lower. This, of course, is tracking activity in the service sector, and so for the Fed, what's going on here from the inflation perspective is critical. This is the largest component of the overall economy and the driver of inflation. And from the employment perspective, of course, critical as well, because it's that employment that is the driver of inflation. So if we take a look here, of course, at what the Fed's main focus continues to be, it is the idea that inflation has fallen much more than labor costs. We can see here the employment cost index, the ECI, is down less than 1% from the peak and into the latest data, whereas over the same period, we can see a really dramatic decline in overall inflation, CPI down from 9 to 3 at the headline, from almost 7 to 4 at the core. And so the issue clearly still in front of the Fed is we've brought down goods inflation to essentially nothing. We've squeezed out a lot of inflation elsewhere. The bit that's lingering to get us from that 3.2 to 2 is the fact that we still have sticky inflation in the labor market. Hence, the employment cost index is not down nearly as much. And that is because we still have this labor shortage. The blue bars there show us how much of a deficit we're still looking at, which at this point is about 3 million workers. Now, of course, that's about half the peak of the deficit at 6 million, somewhere in the back half of 2021, early 2022. But nevertheless, it is a meaningful shortage and much larger than the shortage that prevailed before the pandemic. In fact, about twice as large as the shortage that prevailed before the pandemic, which averaged something like 1.2, 1.5 million. We can see that building out right here. So as baby boomers begin to retire and the overall labor force starts to come in, we start to get a little bit more of a shortage. Then with COVID, of course, there's a dramatic surplus of labor because everything goes on lockdown. As everything reopens, we open to a much wider deficit than before the pandemic. And so that's really the thing bedeviling the Fed here. So if we look at what is going on here, then this is the main issue because, of course, the service sector employs the majority of the U.S. economy. So as we look at this and we see, okay, well, if out of this report, the underlying number for employment suggests that we continue to get another month of slowdown here, which would be, incidentally, the third month of slower jobs growth in a row. We can see it's been slowing here already and is now essentially at the 50 mark. So almost at standstill. Another tick lower here would mean employment is shrinking, which incidentally is exactly what we see on the manufacturing side. We've already seen the manufacturing survey out of ISM. This will be the companion services one, but the manufacturing one came out last week, and here we can see the index unchanged, but in contraction territory. Employment shrinking, new orders, and the price component of the story actually a little bit better here. So we've already seen, at least on the manufacturing side, that November was a month of job losses. If we look at the leading surveys, the analog ones to these from S&P Global, that set of PMIs suggests that indeed we saw in November the very first time that both manufacturing and the service sector lost jobs since mid-2020, which would indeed be yet another piece of the Fed puzzle here to suggest this bit is unwinding, labor demand is fizzling, the Fed doesn't need to raise rates anymore. And indeed, as it has been with Australia, with Canada, as we just saw, and arguably starting here, a dramatically dovish shift in policy expectations. We can see here, even just versus a week ago, which is the small dot line here, a much flatter curve. And of course, since the policy announcement, an even more significant adjustment. If we look at the expectations at this point, the first cut is fully baked in for May at this stage. A second one is there for June. A third one no later than September. A fourth one by November, and 5 full cuts by December, or through December, we should say. So rates are seen coming down dramatically next year by 1.25%. And all of this labor market data, if it comes in on the weak side, as the leading indications seem to suggest, that would endorse this idea But again, the question becomes, is this what the markets care about? As with the RBA, as with the BOC, and with last week's ominous performance in mind. Let's remind ourselves, yields fell a lot last week around this adjustment in policy expectations. Stocks didn't make much hay of it, especially the rate-sensitive NASDAQ. So the question then becomes, have the markets stopped caring about rates being lower as a baseline story, and do we now care more about why they're lower? And if that's the case, if stocks can't rally on soft U.S. jobs data and dovish cues from major central banks, well, then something very significantly weak has crept up into global equities markets. Then the U.S. dollar is due to stage a rebound. Then gold might build on today's losses despite having spiked to a record high. Then negative tidings are ahead for cyclical commodities, be they crude oil or copper. We won't even touch natural gas because it has been plummeting so aggressively. It's barely holding on to any semblance of pricing power at all. So if in fact the markets have switched focus, and it's the recession that matters now rather than the rate cuts meant to push back against it at their face value, well, then there's a very different lens that the markets will have on incoming economic data from here. And we might be able to see that early before a deluge of economic event risk comes at us next week with U.S. CPI and, of course, the last Fed policy announcement of the year. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at what happened on Wall Street on a given day and what might then follow. I'm back on with Chris for Futures Power Hour on Sundays, on with Tom and Tony for First Call on Sunday, and that's Futures Power Hour on Fridays. Hopefully I got that one right. And, of course, as ever, I am writing for the News and Insights portion of tastylive.com and opining on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. Macro Money will be back tomorrow. Happy trading. See you then.